This episode is brought to you by SS&C Mineralware. Are you managing mineral assets and feeling overwhelmed? Unsure if you're getting paid what you're owed? SS&C Mineralware is here to simplify the management of your minerals, royalties, and non-operated working interests. Mineralware's out-of-the-box features give you the tools you need to visualize and keep track of all of your assets in one place. Mineralware lets you know in seconds where your interests are, what's active, what acreage is open for lease, and if you're getting paid what you're owed. With Mineralware, you can even automate your revenue and JIB processing and eliminate tedious manual data entry, allowing you to focus on more pressing issues. Thousands of mineral owners rely on Mineralware to keep their mineral management simple, automatic, and all in one place. Take control of your mineral assets today with SS&C Mineralware. To see a demo, you can visit their website at www.mineralware.com. That's mineralware.com.
Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to cover the latest oil and gas and mineral rights news for June of 2026. And, like the theme has been for this year, we're going to give an update on oil prices and what the market is talking about there, given the war in Iran. And then also talk a little bit about some of the domestic things going on here in the United States and, what some of the policymakers are saying about oil prices. And then, gas prices, price at the pump. Obviously, we're just getting past the Memorial Day weekend, and that marks the start of the summer driving season. And that's usually when you'll see a little bit higher gas prices just because of demand. But, obviously the oil supply situation has been causing an extra impact this year. But Justin, I thought it was interesting to hear about some of the different prognostications on what oil and gas prices are going to do, how long it's going to take to recover. So we'll give an update there. But what did you think about this month's stories?
All about oil prices. That's without a doubt. But it's interesting to see. I think the story is kind of turning out to be what they had thought, where they were saying, hey, don't get ahead of yourself. We may not see a huge price increase long term. But yeah, it's been all the talk. And I think mineral owners are kind of waiting to see, are we going to see this in our checks? What is going on with this? So good to see updates.
Yeah, it's good to see updates. And I guess right now we probably, not too far off from starting to see some of those royalty checks from when the war started and, when the prices spiked. And so it'll be interesting, to your point, to see, how much we're getting paid in those additional royalties, based on those higher oil and gas prices. And so obviously it's going to take some time. We're paid 2 months in arrears typically. So, takes a little bit of time for it to trickle down into the royalty checks. But, we have an interesting article that's going to talk about how, in my opinion, there's a lot of things that are going to offset that increase that we're seeing in the royalty check in terms of increased cost for goods and in particular fuel. So we'll talk about that as well. But do you want to dive into this first article?
Well, let's do it. So the first article here is the Dallas Fed president says the world needs to consume less oil and gas. So Federal Reserve Bank of Dallas President Lori Logan says the world may eventually have to reduce its consumption of oil and natural gas to bring volatile energy markets into balance. Speaking at a closed press conference, Logan emphasized the reality of physical supply constraints, noting that the current rate in oil and gas consumption is not sustainable. Logan expects energy markets to stabilize before too long, though it may force a downward adjustment in global consumption. So, Matt, this was interesting. It's a bit of a surprise to hear the Dallas Federal Reserve president saying this. So I think that's why it's in the news.
Yeah, and they're the ones that are usually the closest to oil and gas activity. They poll a lot of the different executives at the different oil and gas companies to understand the sentiment in the industry and what's going on. And so they're, pretty closely tied, I would say, to what the industry is doing. And so, yeah, it's interesting to see that. And I guess it makes sense if you think about it from the standpoint of when you have lower supply, you have to adjust demand down to meet that. So, when it comes to supply and demand, there's only so much oil or natural gas to go around. Well, you can't really do anything about that. Even as if you had a higher demand, you're going to have to, ratchet that down based on the available supply. And so I think that's some of what goes into this and that thinking. And I don't disagree with that. Obviously the global consumption has to meet global supply at some point, and that's where the price is set, basically based on that connection of supply and demand. But it was interesting that they're using this to understand what inflation is going to do, and I think the big takeaway here was they're seeing that surging oil and gas prices are likely going to have a knock-on effect in inflation, and goods and services are going to go up. And so, when you think about the Fed, they're set with trying to set the interest rate, right? So there has been talk around potential lowering rates. And of course, with this price spike and all of that, they're kind of basically tabling that whole discussion and saying that they need to at least maintain it flat, if not increase rates. So that was sort of an interesting guidance that I think you could take away from that. But I think the real headline for me was the last paragraph in this article, where it talked about that U.S. oil and gas producers are highly unlikely to ramp up production in the near term. And basically, stating what we've been saying all along is that they require prolonged, stable, high prices before they start making those decisions. And that starts impacting their budgets. And so that's where you see at least a 1 to 2 quarter lag. So 3 to 6 month lag between when you see higher oil prices, for example, and when they might think about actually adding a rig to the schedule. For example, if they have increased cash flow coming in from those higher prices, when they start to say, okay, how are we going to spend this extra money that we had coming in that we didn't budget for at the beginning of the year? So it's going to take some time for that to trickle down into, certainly publicly traded oil and gas companies are going to probably be the slowest to react. But, a lot of that too, for those companies, they may actually use that money to buy back stock or increase dividends actually, rather than drilling additional wells. So there's other levers they have with that additional cash flow coming in. But, I think it kind of establishes the fact-based approach to what the oil and gas companies are going to do versus the drill, baby, drill tagline that you hear. And, obviously that's great on paper, but honestly, oil and gas companies have learned the lesson, and they're not going to, quickly ramp up activity because of the risk of prices falling back down, and then they're out on a ledge. So I thought that was an interesting take as well.
Yeah, I thought it was really interesting to hear it. And like you said, I think it confirms kind of what the sentiment was and what we were hearing some folks in the industry. But, the massive volatility, I think, for the oil companies is really what they're not going to act quickly on that, because they've, like you said, Matt, they've learned their lesson when it comes to that. So they're really going to wait for a market that is more sustained, even if it means, smaller profits, it's longer sustained profits.
Yeah, that's a good point. Well, speaking of volatility, do you want to talk about this next article?
Oil prices fall sharply as traders eye progress in the U.S.-Iran talks. So the article here from BBC says oil prices fell on Wednesday as traders eyed signs of progress in the latest round of talks between the U.S. and Iran. The Brent Front crude contract traded at $92.63 per barrel, down 4% or $4, while the U.S. West Texas Intermediate front month contract was down 5%, about $5 to 88.84 per barrel. That's after the U.S. launched fresh airstrikes on Iran on Monday, targeting its missile launch strikes and boats, and claimed they were planning mines in key maritime artery of the Strait of Hormuz. So, Matt, I think this goes right back to the volatility mentioned. Like you said, things are progressing quickly. Nobody really exactly knows what's going to happen. And that does not really make a good environment to make good decisions.
Yeah, it does seem like they mentioned here this circular and endless loop in this ceasefire, in these talks that are going back and forth between the U.S. and Iran. And thankfully, the ceasefire that was announced in April has largely, stayed in place. And there are a few tankers making it through the strait, but they're turning off their transponders. They're going dark, and trying to sneak through, so to speak. And then Iran is, basically taking a toll, and they're negotiating with individual Middle Eastern countries apparently to enact a toll to pass through the strait. So who knows if those tankers that are passing through have paid that toll, and they're just, taking off the transponders just to try to sneak under the radar, so to speak. But it's interesting to see that this is still dragging on, now nearly 6 weeks later from when that ceasefire was originally agreed. And there's yet to be an agreement. So hopefully it stays in place, and hopefully we see an increase in exports from the Middle East, because that's going to help stabilize oil and gas prices, oil prices in particular. just because it's been, like we've seen it week after week, it's, from $88 to $115 and then back to $88. And so it's just all over the place. And obviously, like we talked about in the last article, that is no environment for companies to be making investment decisions. They're wanting, stable, high prices before they start increasing activity. Of course, we're going to give a little bit of a preview of what that's starting to look like with the rig count and some movement there. That I was a little bit surprised by, which we'll talk about here in a second. But before that, let's talk about our, pocketbooks and really the things that we're seeing here in the U.S. in terms of the impact of these higher prices.
It's been a bit of an impact, Matt, and I think we've seen it at the pump. We're going to see it in our bills, and this isn't going to be over, really quickly. We're just going to see these effects for a while. So the article here says gas prices will stay above $3 until 2032, even if the Iran war ends very soon. Goldman confirmed that the grim outlook aligns with what future oil markets are signaling. He explained that bringing gas prices below $3 per gallon in the U.S. would require Brent crude to fall under 70 per barrel, which faces a lot of obstacles, even if the Iran and U.S. agree on a deal to end the war. He noted that simply restarting Iran's oil production would take 2 to 4 weeks. Restoring the country's full pre-war output capacity would take considerably longer. Goldman said, "You need to fix your facilities because so much of them have been blown up in the war." Goldman said he pointed to a chart showing Brent oil futures and said it is going to take a huge amount of time for those prices to hit pre-war prices when a barrel was going for about 67 the day before U.S. and Israel carried out joint airstrikes on Iran in late February, starting the war. So, Matt, I don't think this is really a surprise. And when you look at the numbers, the previous article kind of went into them a bit, and it talks about the Brent crude and West Texas Intermediate has risen by over 30 and 35%, respectively, on a 3-month comparison since the Iran war began in February. But both are down by more than 10% on the previous week, by more than 17% on the previous month. So, Matt, that's just back and forth, up and down, depending on what's happening geopolitically.
Yeah, and it's up quite a bit. And I was just looking at the AAA fuel price website, which we'll link to in the show notes before. And its current average price for regular gas is $4.45, and a year ago it was $3.17, and just a month ago it was $4.11, and that was after that attacks had happened. But that's a 40% increase from a year ago. And if you would have looked at what oil prices were, like we said, $67 before the attacks occurred. I think if we didn't have this Iran war, we'd be looking at closer to the year ago average of about $3 per gallon for regular unleaded. And, I noticed this. We went to a wedding over Memorial Day weekend. And so I drove up into Wyoming, and I was telling Justin before we hit record that on the way back, I was, looking in. I was like, okay, I need to fill up before I get to the next big town that had a gas station, which was Rawlins, Wyoming. And there was this place at a junction between where one highway and another one meets, where I was going to be going through. And I saw that there was a gas station there, and I needed to fill up. And I pulled in, and the gas, the price for regular unleaded was $5.99 a gallon. Of course, they have a captive audience because they're in the middle of nowhere, and if you need gas there, you gotta pay whatever. It's a good lesson in supply and demand, I guess. And so I put a couple of gallons in to get me to Rawlins, where I could fill up at a lower price. And anecdotally, I saw prices in the low $4. Outside the resort places where we were, I'd say about $4.39 was a good price. Between $4.39 and $5 was kind of what I was seeing for regular unleaded, which was pretty high. Certainly considering where we were a year ago. And it seems like the summer driving season, the moral of the story is going to be high gasoline prices and diesel in particular. Diesel is really high. So interesting to see if this actually impacts people's travel plans. And I know you mentioned, Justin, that airfare prices are up quite a bit as well because of the higher fuel prices. So, is that going to impact people's travel plans? I think it will. Just given, you have a fixed budget and you're looking to spend on vacation, and you're going to adjust to stay within that budget. And that might mean changing your plans. So it's going to be interesting to see how this plays out on the economy. And, is that going to mean decreased spending? And, decreased spending means lower GDP and all of those things. And I think all of this is kind of leading towards economic activity dropping a little bit because of these higher prices. You can only do so much with the amount of money you have, right? So it's an interesting dilemma.
Right now, going into December, it seems like the talk is all about oil itself. But Natural gas is also going to be something that needs to be considered. And as we head into winter this year, I'm sure there's going to be higher prices that we're going to see for that, which makes an impact in a different way, but just as substantial. So definitely be something to watch, and hopefully we can fight inflation. But yeah, man, it's an interesting scenario. I always think about the energy poverty conversation that we had and how much access to cheap energy really impacts our lives greatly for us here in America. Less, thank goodness, but it still has an impact on our pocketbook. It can make a big change either in utility bills, travel plans, all kinds of different things.
Yeah, there was an article I saw, and I have to pull it up here, about the UK and energy prices going up and how the number of households it was going to put into the poverty classification because of those extreme increases in energy prices there, because of the policy decisions largely that the UK has made around stopping drilling and things like that and decreasing production from the North Sea. And companies are looking at totally getting out of the North Sea because of those policies that the UK has put in place. And the result of that is it means that their citizens have extremely high energy prices. The high price of heating their homes and electricity and all of those things is, extremely high. So that's, the energy poverty is a real thing. And it's certainly, this is exacerbating that problem with these higher energy prices. And a lot of what we say around oil and gas and minerals and royalties, obviously we like higher prices to a point because it means we have bigger royalty checks. But the fact of the matter is, for most of us, the royalty income is only a small percentage of our overall income. And if it means our expenses are increasing greater than those royalty checks are increasing, then it's net negative, when you get above a certain point. So, and I think that is kind of where we're at right now. And it would be good to see a resolution, the Strait of Hormuz reopen, prices, oil prices are not going to go down below, $70 a barrel, I don't think, for any time soon because of the pent up demand that's out there. But if they were to drop a little bit, I think it would help with balancing that increase in the cost side of things, with the increased royalties. So yeah, it'll be good to see that resolve. And, June, hopefully we'll see some movement this month, in that area, but time will tell. As we always do, let's wrap up with the rig count. Do you want to talk about where we're at, Justin?
Yep. We're up 7 units for the week here. And it looks like we're mostly in the Eagle Ford and Permian, so Texas areas. Again, it looks like they're depending on plays that they know, working from platforms that they're already working and trying to be smart. It's an increase, but nothing substantial.
Yeah, the offshore count is up slightly. Land rigs is up 5, we're down 17 from a year ago. So 5 is probably the biggest increase that we've seen in quite some time, actually. So it'll be interesting to see, is that just a blip in that, if that continues next month, or is that something that is going to be sustained? And are we actually starting to see some of those smaller operators starting to add a rig to reinvest in drilling more wells? It'd be interesting. I would say probably not. I would say this may be somewhat of what's already been in place as far as plans. But it'll be interesting to see if this thing ticks up and if we can actually grow the rig count compared to last year as we get further on in the year. If prices stay high, I think that we will start to see that. But if you have minerals in Texas, I think the moral of the story here is we're seeing most of that increase in activity occurring in Texas and South Texas, Permian, a little bit in Oklahoma as well. Good to see a little bit of an increase. Like I said, it really, time will tell the truth as far as what's really going to happen around increased activity. And I think like I said, by the end of the summer, if we still have prices where they're at, or, in that kind of above $80 range, then I will say that I think we'll start to see a few additional rigs as a result of companies looking to spend that additional cash flow. So good story, I guess, overall. If you don't think about the expense category in your profit and loss statement, from your house and your personal finances, your household. But end of the day, I think the best outcome will be resolution of the war, and then prices coming down a little bit. I think it would help everybody out. From the operator perspective, I'm sure they want to see stability. And even if that's a bit lower price, it's a lot easier for them to make plans for the next 12 to 24 months if they have some idea of where the oil price is going to be. Yeah, absolutely. All right, well, that wraps up this month's episode. If you have an article you'd like us to cover in a future news episode, you can email it to feedback@mineralrightspodcast.com. And as always, we'll link to all the articles we talked about in the show notes, which can be found at mineralrightspodcast.com. Thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.